Hello and welcome to episode 6 of Service to Savings. I'm here with Greg, my co host, and we're coming to you from Rhode Island. And today we're going to be answering a whole bunch of questions that were submitted to us and on a couple of different topics, really kind of dealing with some current events. Just so everyone knows, we're recording this on November 17th. So we're kind of in that post shutdown week right now. So that kind of flavors some of it. And we're also at the end of the tax year, or nearing the end of the tax year. So it's time to do some of that tactical move type stuff. So with that, Greg, are you ready for the first question?
Heck yeah, fire away.
Okay, so going back to your wheelhouse, taxes. Should I realize long-term capital gains this year? I have about 9,000 in long-term capital gains and an income of about 25,000 this year.
Okay, so I'm in my assumptions. I'm just going to make the assumption that that's either taxable income or their AGI that'll hit their tax return. Maybe that's their base pay. I don't know.
Yeah.
So first, let's take a second and provide some education on long-term care or long-term care. Let's talk about long-term care instead. No,
Let's not talk about that. Is not a fun topic.
let's talk about capital gains and why it's such an interesting thing when we're doing tax planning. Oftentimes when I sit down and I walk through a tax return with the people that I serve the first time, I say, hey, do you understand that how all of these different incomes first arrive on page 1 of your tax return, and then 2, how it ends up at that number of what you owe in taxes? And most income just gets taxed at our ordinary income rates. We have a progressive tax scale where we have certain brackets. We have, the 10, 12, 18, 22, 24, 32, et cetera. But capital gains is such a great planning tool because it has its own brackets. We have the 0, we have the 15, we have the 20. Technically, there's more, and then there's the net investment income tax. But we're just gonna focus here on 0, 15, 20 because that's where almost everybody that is going to end up. That is a big driver of this conversation. What should I do with long-term capital gains? If I only had $25,000 of income, there's a good chance, actually, it doesn't even matter if I was going to ask if I'm married or single in this scenario, but it doesn't matter because if I earn less than 48,000 and change, I'm going to get taxed 0% on long-term gains. So if I have made trades and wasn't paying attention, and now I have this income that I'm going to see on a 1099 regardless, then it's going to be okay. I'm going to pay 0% tax on that, which is a good thing. When else are you going to receive income and pay a tax at 0%? It doesn't happen all the time. So there's a massive opportunity there, and they have a ton of headroom if they really only earn $25,000 of income. They're only like halfway through the bracket before then they get paid, or they would get charged 15% on that 9,000.
Right.
If you're married filing jointly, just so you guys have some benchmark for yourselves, and you have $9,000 of income, the 0% tax bracket goes from 0 to 96 or 97,000. I believe
It's essentially double what the
yeah,
single one
we'll
was,
just call
right?
it, multiply that by 2. So that was good math, I guess I did then.
You did it on the fly.
You can either memorize the brackets or just multiply by 2. So we get $96,000 of income, almost $97,000 of income before our long-term gains get taxed at the next higher rate, which is 15. Now, if I'm earning 90 some odd thousand, I'm probably in that 12 to 22% bracket anyway if I'm married filing jointly. So if I'm paying 22%, 15% is still a deal. But if I'm in the 18%, 0 is still a steal. This is actually something that we can do tactically and select. Hey, no, actually, I am going to recognize some gains, or I already made these trades. I was playing in my account, and luckily, we're going to be good. Also, I always like to insert that don't touch your investments. I know it's fun and sexy. Investing is like a bar of soap. The more you touch it, the less you have.
It's a good analogy that I've never heard before, and I'll always keep with me now, Greg. Thanks.
You're so welcome. Yeah. So I actually, if you've already incurred it, then you will be lucky. You will pay 0% on it. So if you're so back to the original question, should I recognize this long-term gain this year? Well, the answer is if you are in a lower than normal income year, heck yeah, because you know that, hey, this is probably the least I'm ever going to pay tax. some year in the future, I could either be in a higher earnings period, which means more tax, or I have no idea what the tax code's going to look like in the future. Maybe it goes higher. Now, for 11 plus years, I keep saying that it has to go up and it keeps going down. But eventually, just like a clock, I'm going to be right once.
Yes.
So I would rather pay the tax I know today than the one I don't know in the future.
Right. So, even stepping back a little bit, so let's make sure everyone understands. So, long term capital gains, number one, is something that you held for a day or a year and a day, right? So, it has to be over a year. And then, normally with this type of gain, we're really talking about a brokerage account here. We're not talking about any type of qualified account. And a qualified account is a fancy way of saying a traditional or a Roth retirement account, whether it's an IRA or a 401k or a TSP, right? Those ones are taxed differently. So we're not talking about those. But if you have a brokerage account, you have some gains in it. And if you happen to be in that 0% tax bracket this year, 100%, you held it for a year, sell it, pay 0% taxes and you can buy it back literally minutes later and get that step up in basis, right? And what that does is your new cost is whatever you bought it at newly because you just recognize those gains, you realize those gains, and you have them now you paid taxes at 0% on them now. Just know also that this is different than selling for a loss too, right? So if you sell for a loss, you can't buy back the asset for 30 days. So you have to wait at
Right.
least 30 days before you buy it back. So to lock in the loss. And so you just want to make sure that you're following those rules. As always, with anything like this, everyone's individual situation varies a little bit. Make sure you check with your tax professional and your investment advisor before you do any of this. But again, you know, if they go, why would you want to do that? Maybe it's time to find a new person. So,
Yeah, and you hit on two really great tax strategies that apply to pretty much anybody that has the income to invest if you're saving and it's not just in your TSP or 401k at work. Non-retirement accounts are actually an amazing tool. They're not oftentimes, I mean, they're actually an amazing tool for retirement, even not being a retirement specific account. Let you fund gap years. They let you fund expenses. They let you fund education. Like there's so much great things that you can do with a non-retirement brokerage account. There's so many great names that our industry has created for these things. We can call them individual accounts or joint accounts or trust. Depends on what we wrap them in. But you mentioned two great strategies: tax loss harvesting and tax gain harvesting. Everybody loves to talk about tax loss harvesting because even in these accounts, I can actually take losses and offset up to $3,000 in a year of my ordinary income, which is really cool because like our passive loss, like, all right, so just to get a little bit in the weeds here and hopefully not confuse everybody. If I have a rental property that loses money, that doesn't offset the money I earned on like a W-2 paying job. But my investment losses could actually offset a little bit of that income, thus saving me some money in taxes. Practitioners and planners and everybody alike loves to talk about tax loss harvesting, but not many people talk about what you brought up with this tax gain harvesting idea. And to my point where I don't know what the future tax brackets are, or in this scenario's case, I know that I'm in a unique situation where I'm in a very low cost period of my life. I can recognize that, hey, my investment in whatever soup du jour is, I'm going to keep that investment. I bought it because I want to hold it for a long time. But what I can do is I can prepay some taxes knowing what the environment is today so that when I sell it at an even bigger gain in the future, future me is going to be so grateful, especially if I can lock in a 0% long-term capital gain. So that's huge. And to your point about wash sales, so that's again, that's this silly tax tripwire where sometimes the IRS will be like, hey, you know what? You sold that thing just trying for the sole purpose of creating a loss so that you didn't have to pay taxes because you bought it back in 29 days. They will actually offset that loss. Like you won't get to keep all of it. But it doesn't work like that for tax gains. What you said was I can sell it and literally buy it back in a couple of seconds or a day
yep.
later. And now I have this new cost basis and paid zero tax on that gain that I created. So, I mean, arbitrarily, let's say that I have $9,000 of gain available. Maybe I paid 10,000 going in and it grew to 19,000. I sell all of it. I pay $0 on the 9,000 that I got from crowdsourcing my wealth. That's what I call
Yep.
this thing. And then I buy that same thing because I still believe that it is a investment that's going to create value. All I
Yeah.
did was saw an opportunity to pay zero tax. Huge.
Yeah.
Love that.
I yeah, I love this, and where you tend to see this is when with people entering the service their first year, they might not have a full complete year. They're not being claimed as a dependent anymore, and their income is still relatively low, right, for that first year.
Mhm.
That's where you tend to see it. Or if you're in some type of student program, sometimes and you're not being claimed as a dependent anymore. Here I'm thinking service academy specifically, because the cadets and midshipmen are not considered dependents of their parents anymore. So they're able to do that. Yeah, it's a great opportunity.
So in our circle, Joe, even with some of obviously the enlisted and junior officers have like a naturally low income, but this might be a good thing to look at when you're deployed in maybe like a hazardous duty area, like where you have that
Yeah,
like tax free zone. It might be worth considering. Well, hey, do I have these excess gains, this opportunity to right my ship in terms of future tax planning? Or maybe I just really wanted to rebalance a few positions. Those years when a large portion of your income isn't going to be taxable anymore, well,
yeah.
that's probably going to lower your tax bracket, which might drive down your capital gains cost from 20 to 15 or 15 to 0. It's a good opportunity to do a little review.
Yeah, it definitely is, and that's one of those places that huge savings, right? Especially when you calculate it out over the lifetime.
Yeah. I think here's I guess, a safety wire or a warning that we should share with everybody, Joe. There's a cliff on this. What drives that tax bracket for 0, 15, 18, or 20, excuse me. It's not just your capital gains that goes into that. It's your total income plus your long-term gains goes back to those numbers that we referenced earlier, the 40s or the 90 some odd thousands. You have to be careful of that, right?
Right. So going back to our example that we started out with, right? The tax bracket tops out at 48,000 and change. They said they made $25,000 in income. So the first $25,000 of that 48 is offset by their income. So they don't really start at zero, they start at 25,000. And then you add in another 9,000 and so now you're up to 34,000. So you're still not out of the 0% tax bracket, but you may be closer to it than you think because that's why that low income year is really important, is because it sets your floor for where your taxes start at and how fast you progress through that first tax bracket.
Yep. So just be cognizant of, where your base pay, your bonuses are at, any spousal income, other investment income,
Yep.
where high
Interest
yield
in
savings are all the rage right now. Well, that investment, the 1099 INT might bite you in the butt.
yes. So okay, next question. Shutdown's over. What should I do now so that it's not as stressful the next time?
Hmm. So I have a couple thoughts on that. And I think off the top of my head, I would say, do we have any immediate financial triage? Do we have any debt to catch up on? Obviously, with the caveat of don't splurge. Um, and then, rebuilding any emergency funds or use this as an opportunity to reassess emergency funds.
Yeah.
And this is also a good trigger to say, like, well, how financially resilient was I during that period of time? What do you think?
So one of the things I'm thinking of is if you took one of those 0% or low interest loans for whatever reason, know that when all those back paychecks hit your account, like they're not really yours. Like they have to go back to pay back that loan, and the payback's relatively quick on most of
Mhm.
those. Every bank's a little different, so it's hard to say specifics there. But just know it's normally like within months that you're paying that back. So know that that money's going to come out, right? And if you do splurge, right, you're kind of that loan's kind of a chainsaw, and you don't want to cut off your leg, right, with it. So make sure that you're careful that you have the money to pay off that loan. And then yeah, I love doing that kind of self-awareness type thing of how successful was I? Was I losing sleep? Was my wife freaked out, or my spouse freaked out? Did I have to cancel cable, or whatever? Because that really affects everything.
Yeah, I mean, sometimes we might be forced to rack up debt. Maybe our initial readiness wasn't what it should have been. You might have some support from the Service Member Civil Relief Act. There might be a little bit of protection there. But you're going to look at your initial bills. Did we miss anything? Did we have late fees, missed auto payments? We can talk to creditors. We can get caught up on those things that, like, all right, hey, I did take out to their point to that loan. I just need to account that that money is just going to go right back to that. I would say sometimes when we get back pay, like we've adjusted ourselves to like this hot poverty, but like certainly a scarcity behavior. And then when we get that, we're in the, it's almost like, oh, hey, surprise money. Yay. Try not to spend it. I know that's like, it seems like such a simple thing to say, but that's a good time where, hey, you know what? If I did adjust and my lifestyle really, the impact wasn't that bad, we were fine, but now we are getting this pay. Maybe that's an opportunity to save a little bit more so that it's even easier the next time it happens.
Yeah, I mean, that's what comes to my mind is if you decided when you do that self-assessment that your emergency fund wasn't big enough and now you got extra money in the account because you didn't spend some of the money that you would have in the previous couple months, great. Throw it in your emergency fund and get it up to the level that it should be at.
Yeah. And for if it hurt, like if the shutdown was painful, then that just means that, hey, maybe we need to expand the emergency fund, add a month or so. Or if we really leaned into credit cards during the shutdown, maybe we need to think about how we spend or if there's a better way to optimize. But really, like, I just like, I don't want to cast shade. Like, I like the opportunity just to reflect and learn on what was hard and what went well, even. So, what worked, what didn't, where were you vulnerable? For me, oftentimes in my own past experience with any of these things was it wasn't so much that the money coming in or not coming in for a certain period, like I can usually make those gaps, but just small little things like just changing the timing of when this money hits versus what my automatic payments were. I mean, some people like to manually pay bills. I don't. I like to automate what I can. But
Yep.
sometimes disruptions just change the timing and you didn't actually do anything wrong and you had the money and you were able to go back and pay it. But when things get turned off and your timing gets out of alignment, that's just
Right.
a good opportunity to say, well, oh, that just means I need a bigger buffer here, or I need to change the automatic setting of that to account for those kind of delays.
Right. And I don't know, I'm sure it's the same in the Navy as in the Coast Guard. After any major evolution, right? We always do a debrief or a hot wash, and or an after action, right? And so it's not bad right now to kind of take stock of where everything is.
Or a critique when we break things.
Yes. And with that in mind, too, one of the things that I've heard, and I don't know anyone personally that this has happened to, is TSP contributions were out of whack during the shutdown. So that is something that I think everyone should 100% double check and track is that both their TSP and if you're under BRS, your matching is going into the account that it should with the correct amounts. Just know that in previous shutdowns, this has happened. You're not going to get whatever happened to the market during the interim while they didn't make those deposits. So you're not going to recover that, but you should get all of the contributions that you expected to go in.
Yeah. This is just another example in a previous episode when we were talking about depreciation. I said good record keeping is going to save you a lot of time and headache in the future. This is actually a great example of that in terms of your benefits. We all know that the government, whether it's Aunt Iris or Uncle Sam, they are so good at collecting your money. Like when you get orders that changes this bonus that you were expected to get, or and you already spent it, like they're going to come back and get it.
Right.
But that doesn't mean that they're as diligent or it's as much of a priority to make sure that you get what's yours. So know how much is supposed to be going into your TSP or how much you should have been contributing into that BRS. Those things are important to you and your family and your future livelihood. It doesn't really help you or serve you to leave it up to the government and hope that they do it right. Just
100.
keep good records.
So next question up is a new service member. What should I do about credit cards and building credit? And do I try and maximize rewards or what's best?
So, I'm coming into this conversation with a ton of baggage and bad behaviors. And there was a period of time, not even all that long ago, where I like destroyed my credit. Like I'm talking like I'm happy to say, just for all the listeners, that you can fix it. It's a hard road, but I'm in the 800s. So understanding what makes your credit should be part of this conversation. Being active duty, I can't think of a reason why you should ever pay an annual fee. there's so many credit cards that have benefits where you can get all of these extra perks without paying the annual fee. There is a whole community on playing the points game and maximizing your wealth through these points for things like travel. There's some very influential podcasts and writers that I would defer to their excellence on this in a heartbeat because I try not to use a ton of debt. But what I see in practice is the best thing that you do is just pay it off always. Like that should just be like number one. Hey, if I'm going to use credit cards, they always get paid off. I never pay one single cent of credit card interest. But bringing back into, I've already created good behavior. Now I want to optimize. I look for points on things that I'm actually going to like use. Like, so if you're a heavy traveler, if you want to travel, because we're always promised like, hey, we're going to go see the world. Instead, I'm going to see Goose Creek and grind. That's not true. I did go on deployments and I saw haze gray and machinery gray and seafoam green mostly until we pulled into a port.
I should say the inside of a metal tube.
Yeah. That is an opportunity where you could actually save a ton of money by getting a card and running your expenses through this thing that's going to create these benefits for you. I prefer cash back rewards to the travel rewards because my travel is kind of very targeted, unless they're going to give me Disney money.
There is some new Disney card that I thought I saw,
I'm not
or
impressed. But
yeah.
I like the cash back, that's kind of what I gravitate towards. But I think my first talking point is most cards for active duty service members have no annual fee opportunities. And the next big thing that comes to my mind is build credit history, not debt.
And really, so speaking about credit, right? Really, it's a measure of how likely are you to pay back your debt. And the best way you can convince them that you're likely to do it is by paying back your debt, right? And so you want to make sure that all your payments are on time, and ideally that you're not carrying a lot of outstanding balances on credit cards and things like that. So you want a low utilization of the actual credit month to month. Not saying like if you have $10,000 to pay off the credit card, you can spend $10,000, just pay it off. Which brings me to my favorite saying for credit cards is there are two types of people with credit cards, those who pay them off every month and those who should not have them. And
Yeah.
you need to decide what type of person you are, right? And then go ahead and act accordingly, right?
Yeah.
So another resource, militarymoneymanual.com, right? Excellent resource for military members. It'll help teach you about the credit card perks that you have as a military member and how to choose kind of some of the best ones. One of my personal favorites is American Express Platinum Card because they give you $400 a year in Resi credits, which is $100 a quarter to go out to eat, right? At a Resi restaurant. You get $70 a quarter at Lululemon if you want to buy Lululemon, $50 every 6 months at Saks Fifth Avenue. And my personal favorite, because I do tend to travel a lot, is lounge access. And there is nothing better than being able to go to the airport, eat and drink for free, whether it's coffee or alcohol, right, in a lounge and just being able to go in. And also, they usually have good Wi Fi in there and comfy chairs, and you're not kind of sitting out. I always say it's going into the lap of luxury versus sitting in with the unwashed masses in the airport, right? And so 100%, like I absolutely love that card for that. Chase is another great one to be able to do. Chase, I think it's Sapphire Reserve,
Uh-huh.
right? Is another one that has a lot of great. I think they do a sports ticket like Ticket Hub or something like that. That you get like $150 credit every 6 months. And they have a bunch of other things. So in reality, if you took advantage of all that stuff, even if you had to pay the fee, you would make your money back. But you, as a military member, don't have to pay the fee, and so in actuality, you can get both as long as you are the type of person that pays them off every month uh, and not the type of person that shouldn't have credit cards.
Yeah. So, I mean, just to, I guess, reiterate some key purposes, I mean, there is a distinction between, and it's not even necessarily maturity, it's having just created certain behaviors. If you've created the right behaviors, then there's a great opportunity to do optimization and gamify these points. If you aren't there yet, then and honestly, and I would say this to any new service member anyway, especially like just whether you're an officer, a JO, or junior enlisted, there's a lot of traps that you can fall into. So before I dive into those, I just say like one of the things that you said with your saying that made me think of the other cliche thing that I love to say is if you can't afford it with your debit card, you can't afford it with a credit card. But don't think that like, oh hey, I'm going to be in the military. I'm going to be deploying all over the place. I'm going to use these things, get all these points. Most of the time, you're deploying on orders, and it's not going to be on your dime. So you're not going to get those points. So don't fall for those things. And a lot of these points, it's imperative that you have good behavior because the entire reason why they're offering you points is that they want you to spend. Like that's how they make money is by you spending. So spend where you're normally going to spend. Don't go out and spend just because, oh, I have to hit this number in 3 months in order to get this bonus mileage.
And, they've done studies like the credit card companies are not dumb, right? They are making more money off you than in aggregate, and by you, I mean
Absolutely.
like the general population, then they are paying you in benefits, right? And so otherwise they wouldn't be in business. So just know that and make sure that you really control that spending. That being said, one other thing to watch out for is what is the intro offer and how much do you have to spend in a certain amount of time, and make sure that you're going to actually hit that because those like that 100,000 introductory points is often worth a ton of money and really can make or break kind of the credit card points for you, at least initially.
But you should hit that organically. That should have been like, oh, I was already going to have that recurring expense that's going to get paid off anyway in my normal cash flow. Or no, I'm looking ahead. This is going to be my year's worth of trip. I'm not spending anything after that, and then maybe front loaded. So like, there's a lot of like. I'm really not trying to, I guess, evangelize like don't have any debt, even though I prefer no debt or consumer debt. Some debt is
Right.
good. I'd be a bad finance professor if I said that debt was bad. But consumer debt is problematic for a lot of people. So make sure that this is within your normal spending and that you can afford it. And to your point, then, all right, let's get that intro rate because I don't want to leave all that money on the table, that great opportunity.
And, personally, like my son was looking at getting one of these cards. And I was like, you're not going to spend $6,000 in the next 6 months or whatever it was for the introductory offer. I was like, so it doesn't make sense right now. Wait 6 months. And then you're talking about purchasing a car. You have cash in the bank to purchase the car. Put the $6,000 on the credit card to pay for the car, right? And then pay off the credit card. You were planning on spending it anyways. It works. And
Exactly.
and that's how I would really approach the credit cards. So,
Yeah, absolutely.
and again, 100%, Jamie and Reese do it better for the military than just about anyone else I know on the credit card course. It's free. Go sign up for the at militarymoneymanual.com and take that, and they will teach you everything. And they
Tell
are
them we're
those,
big fans.
yeah, they are points nerds and they are great at it, right? So 100%. They do a really good job with that. So I think that brings us to the end of another episode. So yeah. So with that in mind, let's wrap this up. So please subscribe for exclusive content and updates designed for military life because building lasting wealth with strategies can be helped by working with a military financial advisor from the Military Financial Advisors Association. We all walked in your shoes. We understand what you are currently going through. So, with that in mind, as your career progresses, hopefully it'll bring success. And with that success will come some complexity, especially to your finances. So, when that happens, think about working with an advisor from MFAA to help you navigate that complexity. Visit militaryfinancialadvisors.org to get started. Thanks for listening. Please subscribe and give us a 5-star rating if you enjoyed our podcast. And we'll see you next episode.
The information provided on Service to Savings, the Military Financial Advisors Association's podcast, is for general, informational, and educational purposes only. Nothing contained in this podcast should be construed as financial, investment, legal, or tax advice, nor is it intended to be an endorsement or recommendation of any specific product, service, or investment strategy. Always consult with a certified financial planning professional, preferably an MFAA member, before making any financial decisions, as your personal circumstances, including military benefits, TSP contributions, deployment-related finances, or retirement planning may require tailored advice.